First and foremost, if you're looking at the stock, this is options 101. Okay, if you just tapping in, share this live with 88 trillion people. Okay, so boom. If you on Robinhood, we on Robinhood right now. If you're on Robinhood, you touch trade, right? Appreciate it. You touch trade, right? Once you touch trade, it's going to give you two options. No pun intended. Two options. You can either buy, if you were to click buy here, you will be buying the actual stock. You with me? So you can either buy the actual stock or you can buy the options. If you want to buy the real stock, the real Riot, the real Mara, the real Apple, the real Google, the real Meta, the real Nvidia, the real Verizon, right? You will click on buy. You get it? So this will be if you were buying the real stock. Somebody type real stock. Somebody type real stock in the comment. Type real stock. This is not options. This is real stock. Real stock, right? So let's say you wanted to buy, the number of shares is right here. So let's say you wanted to buy 500 shares of Riot. 500 shares of Riot will cost you $5,720. Okay? This will be how much you will have to pay in order to own 500 shares of Riot blockchain or Riot platforms, right? Because you take this 500 and you multiply it by the market price of that stock. You feel me? So there's two options. That's why I said, if you come here, beginning, just so you understand the basics, you can either be buying the real stock or you can be trading options. When you buy the real stock, you own the stock. You own the shares, right? It's yours. You a stock owner. Okay? If you go with option, the buy option, you are buying to own the actual stock of that company. You are buying to own the actual Riot or the actual Mara or the actual Apple or the actual Meta, right? If you click trade options, you don't own nothing. Okay? So type in the comments, options equals no ownership. If you buy options, you do not own the stock. That is the most fundamental, basic information that you need to get, right? So with options is no ownership. With options, you only trying to make money if you get the direction, if you predict the direction, right? So let me go back. If you come here with the stocks, you can only buy, right? If you're buying to own the stock, you can only buy. You cannot sell something you don't own. So you cannot short Mara or Riot, right, when you don't own the actual stock. You understand what I'm saying? So if you buying a stock, you can only buy with money you got. And see, like I said, if you come here and you wanted to own 500 shares of Riot, it's going to cost you $5,700. So you need to have $5,700 or $5,720 in your account in order to own 500 shares of Riot, right? You will own the stock. When you go with this option, pun intended, when you're trading options, You don't own the underlying asset. You don't own Riot, right? You just trying to make a prediction of where Riot is going to go. So if you predict that Riot is going to go up and it does go up, you're going to make money. You can also predict that Riot is going to go down. And if it does go down, you're going to make money. So the beautiful thing about options is that you can benefit either way the stock goes, right? You can benefit if it goes up, and you can benefit if it goes down. You get it? But if you are actually buying the stock itself, you only buying it to go up. You cannot sell a stock that you don't own. But with options, you can buy a put. And if you buy a put, you're basically predicting that the asset is going to go down. You get it? So far, so good. Are we on the same page? This is Block Street. This ain't Wall Street. This is Block Street. I'm breaking it down so that the average person can understand. You know what I mean? This is the type of shit that they charge you thousands of dollars in courses, right? This is the type of shit that Wall Street Trapper and them niggas is charging you thousands of dollars to give you. And you ain't even going to get this information. But anyway, so when this is basically an option chain. It's called an option chain, right? So when you pull it up, you're going to see the price of the stock. So over here, Riot is at $11.44. That's how much it will cost you to own one share. All right? Over here on the top, right, you're going to see a whole bunch of dates. These are all expiration dates, right? And one thing in common is most of the dates is going to end up on a Friday, because these are the dates that the option contract expires, right? So you can basically choose the date that you want that contract to expire, right? So if you're predicting that Riot is going to go up, you're basically going to predict within this window, right? I'm predicting that by February 2nd, Riot is going to go up to $12, right? Or you can say I'm predicting that by February 9th, or February 16th, or February 23rd, or February, you see what I'm saying? It keeps going and going and going. But the further away the dates, the more expensive the contract is going to be. So far, so good. We on the same page. I hope I'm not moving too fast. Are we on the same page? On a scale of 1 to 10, 1 means you're lost, 10 means we on the same page. Where you at so far? 1 is, I don't know what you talking about. 10 is, I'm with you. Same page? Let me know in the comments if we're on the same page, because I don't want to leave anybody behind. If we're on the same page. 10. Okay, we on the same page. So, when you pull this, so with options, right? With options, there's a few things you can do. You can either buy a call, right? It's four main options. You can either buy a call or buy a put. You get it so far? These are the options. You can buy a call or you can buy a put. If you are buying a call, you are basically predicting that the underlying stock price, which is over here. You get it? This is the share price. Okay? This is the share price. Type in the comment, what is the share price of Riot? What is the share price? So I know we on the same page. This is Block Street. This ain't Wall Street. This is Block Street. This is Block Street. This is for the street. Okay. So basically, you either gonna predict that by these dates on the top, the share price, right? The share price will either go up or it will come down. If you predict that it's gonna go up and it does go up, you make money. If you predict that it's gonna go down and it goes down, you make money. If you predict that it's going to go up and it goes down, you lose money. If you predict that it's going to go down and it goes up, you lose money. Same page? Capiche? Capash? Same page? Capiche? Capash? We on the same page? We on the same page? Copy, right? Okay, so pay attention. So everything here on the left side, all of these numbers here, these are called the strike prices. These are the strike prices, right? Strike price. So this is a $11 call. There's a $10.50 call. This is a $10 call. This is a $11.50 call, $12 call, right? These are all strike prices. These are the prices that you're going to predict that Riot is going to hit by whatever date you choose up here. You get it? So you're predicting that by February 13th, Riot is going to hit $11. So you will buy, or let's say by February 23rd, you're predicting that Riot is going to hit $12. So you're going to buy the $12 call expiring on February 23rd because the share price is here. The strike price is above it. You get it so far? So everything here is called in the money. Anything up below the current share price, all the strike prices that are under the current share price. This is the current share price of Riot. So anything that is below the current share price is considered in the money. Type in the comments, in the money. Type in the comments, in the money. Type in the comments, in the money. In the money means the share price is below the current, the call is below the current price, right? Which means that it's in the money. In the money means it already has intrinsic value. That means that there's meat. There's money already in it, right? Because the price that you are trying to predict is all the current share price is already above the strike price. Does that make sense? In the money means that if you say Riot is going to go to $11, right, by February 23rd, and you buy this, it's already in the money. There's already meat on the plate. You already eating. That's what it means. In the money means there's already food on your plate. Anything above here is out the money. That was a good one. I love that. In the money means there's already food on your plate. So the lower you go, the more food you already got on your plate. You feel me? The lower you go, the more food you already got on your plate. And you're going to notice that The lower you go, the more expensive the premiums are. These are called the premium, right? This is a premium. This is all called strike prices. This is all called premiums. This is how much you pay per one share in order to get into an option contract. So instead of paying $11.44 for this, right, for an $11 call, instead of paying $11, you're going to pay $1.33 for one share. You get it? So this is a crazy discount, because the actual stock price is $11.44. If you were to predict that Riot is going to be at $11 by February 23rd, you can scoop up one share for $1.33. But you notice that the lower you go, the more expensive the premiums is going to be. No, you're not betting against the stock. You're not betting against the stock. You just playing it safer. So if there was a call, because see, we got 11 and we got 11.5, but the share price is 11.44. Let's say there was a strike price that was 11.44. That will be considered at the money. Okay, so you have at the money, in the money, and out the money. So any strike price that is the same price as the current share price will be considered at the money. Okay, at the money. Any strike price that is below the current price is considered in the money, because in the money means you already got food on the table. There's meat on the plate. You already eating. Out the money means you're not eating yet. You hoping to eat in the future, but you haven't eaten yet. Your plate is on the table, but your plate is empty. The person who bought this, there's food on their plate. They might have a chicken wing over here. The person who bought the $10 call, they got 3 chicken wings, right? They got 3 chicken wings. The person who bought the $7.50 call, they got chicken wings and fries and a drink. Y'all picking up this game? Y'all picking up this game? This is a $500 course that I'm giving y'all for free. Right? So everything under the current price already has intrinsic value, right? There's meat on the plate. There's meat on the plate. Also, anything on this side, this is the premiums. But remember, with options, you don't buy one share at a time. Options are traded in contracts, and each contract comprises of 100 shares. So everything you see on the right-hand side, you're going to multiply it by 100, and that's how much one contract is going to cost you. Are you picking up the free game? Everything here, you're going to multiply it by 100 in order to determine how much it's going to cost you. So here, this will be $1.33 times 100, because you're going to be buying one contract, and one contract comprises of 100 shares. You cannot buy half a contract. You can't say, I don't want 100 shares, I only want 88. You can't do it like that. The minimum you can get in is one contract. One contract equals 100 shares. Type in the comment, one contract equals 100 shares. Type in the comment, 1 contract equals 100 shares. Type in the comments, 1 contract equals 100 shares. This is Block Street, man. This ain't Wall Street. Okay, so if you want to know how much it's going to cost you, this is quick math. You take the premium and you multiply by 100. Boom. So this will be $264. This will be $192. This will cost you $160. This will cost you $133. This will cost you $398. This will cost you $490. This will cost you $538. Everything here, you're going to multiply it by 100. Capiche? Capash, right? Okay. You will also notice that the higher you go, the cheaper it gets. The higher you go, the cheaper it gets. So it's a combination of the higher you go, right? It gets so cheap, right? But also the closer the dates. So if you want it really cheap, you're going to choose the closest date. And the cheapest, the highest strike. You get it? That is the worst combination. That is the worst combination. You choose the closest date and the highest strike price. You see how much it costs? You see how much it costs? This is the riskiest option, pun intended, right? This is the riskiest option. Closest expiration, highest strike price, cheapest premium, but the riskiest. You will likely lose your money if you do it like this. The safest and the smartest option is to go all the way here to January 2026 and then stay as close to this price as possible. That is the smartest way, right? So if you were to buy the $10 call, that is expiring in January 16, 2026. This $10 call will already be in the money because the $10 call, the $10 is lower than the share price. And this will cost you how much? How much will the $10 call expiring January 16, 2026 cost you? Type in the comments. $10 call. How much will that cost you? How much would that cost you? $10 call. $670. Okay. Y'all paying attention. This is Block Street. This ain't Wall Street. Okay, y'all paying attention. But check this out. If we go back, pay attention to the $10 call. Let's go back to January 2025. How much will the $10 call? So look at the difference. The $10 call, January 2026 was $670. How much will the same $10 call cost you in 2025? So you're saving about how much? This is Block Street. This ain't Wall Street. You see what I'm saying? Okay, let's look at September 20th. Let's look at September 20th of this year. September 20th. Let's look at the $10 call. How much will the $10 call for September of this year cost you? How much will the $10 call September of this year cost you? This is Block Street. This ain't Wall Street. 410, right? So you getting it. You getting it, right? Okay. Let's go to March. Let's go to March 15th. How much will the $10 cost you? March 15th of this year. How much will the $10 cost you? How much will the $10 cost you? March of this year. This is Block Street. This ain't Wall Street. How much will the same $10 cost you? 231, right? 231, right? 231, right? Okay. Let's go to this Friday. Let's go to this Friday. This Friday. This Friday. This Friday. How much will the $10 call cost you this Friday? This coming Friday. Same $10 call. How much will that cost you? This is Block Street. Block Street Avenue. So y'all picking up this game, right? You picking up this game, right? Because this is riskier. The closer the time, the riskier it is, right? Also, I'm going to show you something real quick, right? So check this out. So boom. So let's look at, okay, this, like I said, everything below here is in the money, right? It already got meat on the plate. Everything here is out the money. So everything here has intrinsic value, right? That's money on the table. There's food on the table. There's meat on the plate. Everything here has the plate ready, but there's no meat on it yet. But it has what is called extrinsic value, right? Extrinsic value basically means that there's potential to make money. There's potential to eat because of time, right? With time, anything is possible. So everything here is based on possibility because of time. With time, this can get to 11. It can get to 11:50. It can get to 12. It can get to 12:50, right? So people who buy this, they are basing their call on the possibility of making money due to time. So the value of time and options is called extrinsic value. The value is based on the possibility of what you can get with time. The value of everything here doesn't need time. It's already valuable. Are we on the same page? Scale of 1 to 10. 1 means you don't know what the fuck I'm talking about. 10 means we on the same page. We eating the same food. Scale of 1 to 10. So far. Same page. This is Block Street. This ain't Wall Street. Okay. Say less. So check this out. Check this out. Check this out. Let's say you knew, or based on your analysis, right? Based on your technical analysis, or maybe you a rich dude and you play golf with the CEO of Riot, right? And the CEO of Riot was like, man, on Wednesday, Riot is buying Mara. Don't tell nobody, right? Wednesday coming up, Riot is acquiring Mara. That is a competitor, right? But they made a move. It's not out yet, right? This information is not out yet. Riot is about to acquire Mara. But I'm letting you know because you my nigga. You know what I'm saying? We play golf and shit together. Keep it on the low, don't tell nobody. And you like, bet. Because you know that once the news breaks, the shit is going to go through the roof, right? But you ain't got money like that. You know what I'm saying? You ain't got money like that. You just playing with $1,000 or whatever. You ain't big timing yet. So you like, bet. I'm going to go buy some options. Because you already know that the moment the news breaks, shit is going to go through the roof, right? So let's say you come here and you like, boom, I'm going to get the $15 call. How much will the $15 call cost you? If you bought the $15 call, how much will one contract cost you? Type in the comments. The premium is 0 point. How much will one contract cost you? $4 freaking dollars, right? $4 fucking dollars. No, not 40. Not 40. 4. Why is one? Why is one? It's not 40. It's 4. $4. $4 for 100 shares. Because each premium, which is essentially each share, is 4 cents. So times 100, right? So you like, boom. So you come here. You come here. And then you hit buy. So as you can see, it defaults to 1, right? Because one contract controls 100 shares. So if you bought one contract, right, it will cost you $4. Right? $4. But you ain't trying to play with no $4, man. I ain't trying to buy no one contract. I'm trying to eat. So you like, man, fuck this shit, man. Let's say you like, man, fuck this shit. I'ma put a stack on it. You like, you know what? Fuck this. I'ma put a stack on it. Right? But you have to understand, this is money you have to agree that you are comfortable losing. Because you can lose this if Riot doesn't go the way you're predicting it to go. So let's say the news never breaks. Let's say your buddy lied to you. The news wasn't solid. The news wasn't shit. This is the max loss. You cannot lose more than what you put in. So whatever you put up, whether it's two contracts will cost you $8. This is $8 that you should be willing to lose. If you are not willing to lose that $8, then don't play this fucking game. You understand? It shows you here max loss. You can lose 10. You cannot lose 9. But you can lose whatever you put up. So whatever you put up is what you have to agree. That is risk management. That is understanding the risk that is involved in any trade. When you are trading, all you are doing is you are fucking around to find out. Okay? That's what trading is. To really break it down, you are fucking around to find out. But in order to find out, you need to put money up. And your money shows how serious you want to fuck around to find out. So if you are fucking around on a low scale, you buy 2 contracts. Right? That means you ain't trying to find out too much, right? You ain't really in it like that. But if you were to buy 250 contracts, how many shares will you be controlling with 250 contracts? Type in the comments. How many shares are you going to be controlling if you bought 250 contracts? Type in the comments. This is Block Street. This ain't Wall Street. Okay. Okay, y'all paying attention. I love that. Plus, it's right here. Right? It's right here. It shows you. An easy math. 250 times 100 will give you 25,000 shares. But check this out, right? If you were to buy the actual shares of Riot, right? How much will 250 shares of Riot cost? Somebody do the math real quick. 250 shares of Riot at the current price of $11.44. How much will that cost you if you were to own 250 shares of Riot? How much will that cost you? Okay now. So let's say, like I said, this is a double-edged sword, right? But the thing is, the max loss is limited. The max profit is theoretically unlimited because anything can happen and the stock can, there's a possibility. It's very unlikely, but there's still a possibility that this can go to $200 or $500, right? There's a possibility. It is possible, theoretically, right? However, the most you can lose is 1,000. You cannot lose. If Riot dropped from $11 to $0, all you're going to lose is this. This is Block Street. This ain't Wall Street. All you can lose is this. But check this out. Let's say your buddy was right. So, first of all, you have to accept the risk that is involved in every fucking trade you put on. Risk management is number one. Capital preservation is number one. So the most important thing for you to do is accept it. This ain't Wall Street. This is Block Street, baby. You have to agree and accept wholeheartedly. If you ain't ready to lose that $1,000, don't play this fucking game. Lower it, right? Lower it. Maybe your heart can only deal with $100, right? Maybe your heart can only deal with $100. So maybe you can only buy 25 contracts. Because this is all you can afford to lose. Don't try to do shit that you really can't just because you see other people buying 250 contracts. So you like, yeah, I'm going to buy it too. Meanwhile, you don't have that $1,000 to lose. Meanwhile, that is your rent money. Meanwhile, that's your child support money. Meanwhile, that is your car note money. You can't do that, right? Because with options, you're dealing with derivatives, right? You're dealing with a leveraged asset. So it's a double-edged sword. You can make a lot of money, but you can also lose all your money. So the most important thing that you need to determine shouldn't be the contracts per se. It should be the amount of money you put in on the line, because this is money that you can lose. If the stock doesn't go the way you're predicting it to go by the time you're predicting it to go. Are we on the same page? Give me a 1 if we're on the same page. This ain't Wall Street. This is Block Street. This is free game. Them niggas with 100,000 followers and 200,000 followers and 1 million followers ain't giving you this game. I could have charged crazy money for this, but I really want people to know for real. But let's say you got big pockets, right? Let's say you got big pockets and you're like, you know what, fuck it, I got a stack. Right? So you buy 25,000 shares. You spend a rack. Money ain't a thing, right? But let's say your buddy was right. So let's say your buddy was right. So let's say your buddy was right. And then boom. Let's say by Friday, Riot hits $16 from $11. Do y'all see this, man? 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 This is a 4,000%. Do y'all see this, man? Do y'all see this, man? Do y'all see this, man? What a fucking... So your losses are limited, right? You know, before you get in, you already know how much you can lose. Worst case scenario, I lose. But let's say you like, okay, maybe I don't have a rack. So maybe I'll buy 125. Buy 125 contracts, right? So you buy 125 contracts, which is equivalent to 12,500 shares. But your buddy was right. Your buddy was right. You spend $500 and you can potentially make like $18,000. Right? Can make $18,000. You see what I'm saying? So that's basically, in theory, that's how it works. That is how it works, right? But like I said, this is best case if you know something and everything goes your way. It can even be crazier, right? And I'm not going into detail because this is options 101. You know, I'm not trying to overwhelm you. There's so many things that you need to understand. Somebody mentioned IV. That is not for this class, right? There's so many things that you have to factor in. You got to factor in the Greeks. You got to factor in the volume. You got to factor in gamma, theta. There's a whole bunch of shit, right? But if you look here, you will notice that, like, even here, to an uneducated eyes, you might be like, and I see this all the time. People hit me up and they're like, man, I bought the 21 call or whatever, but it's not moving. It's because there's no volume, right? There's no volume. You have to look at the volume. The volume is how many people are actively buying and selling the stock, right? That shows liquidity, right? That shows liquidity. So if there's no liquidity, then you're wasting your time. But, you know, theoretically, some people get lucky, and even like with Wall Street bets and shit, a lot of people did that. And that's how people made a whole bunch of money, right? Because they bought the shit really cheap. They spent practically nothing on the contracts. And then when it popped, they made hundreds of thousands of dollars. I actually posted a video right now, a movie right now on Netflix. Y'all need to go check it out. It's called Dump Money. It's about the whole Wall Street bet thing with GameStop, right? But before I got here, my time will be up soon. But before I got here, I wanted y'all to understand there's mainly 4 options. You can buy a call. When you're buying a call, you're predicting that the stock price is going to go above your strike price, whatever strike price you choose, right? So the main options are you can buy a call. Buying a call means you're predicting that the stock is going to appreciate in value. Or you can buy a put. When you buy a put, you are predicting that the stock is going to depreciate in value. that means you essentially shorten the market, right? By shorten the market, you don't sell a call or sell a put. You buy a put. If you think the underlying stock is going to go down, you buy a put. If you buy a put and the stock goes down, you make money. If you buy a put and the stock goes up, you lose money. The same way, if you buy a call and the stock goes up, you make money. If you buy a call and the stock goes down, you lose money, right? So that's the main options. You can buy a call or buy a put. Or you can sell a call, right? You can sell a call or you can sell a put. When you sell a call, in order for you to sell a call, you need to own at least 100 shares of the underlying stock in order for you to sell a call. Because remember, when you are buying a call, you are buying it from somebody who is selling a call. Capiche? Capiche? Capash? When you buy a call, there's somebody else on the other side of the transaction. When you buy a call, somebody has to sell it to you. You can't buy if nobody is selling. The person who is selling has to own at least 100 shares of that stock in order to sell you that call. You get what I'm saying? Does that make sense? For every buy, there has to be a seller. For every time you want to buy something, somebody has to be willing to sell it to you. The person who is selling it to you actually owns the actual stock. They bought the real stock with real money. If you with me, give me a 1. The person that you are buying it from, the person is selling it to you. But they're not selling their actual stock. They just lending it to you so you can make money off of the direction if you get it right. You see what I'm saying? So in order to sell a call, you need to own 100 shares of the underlying stock. In order for you to sell a put, you need to put up how much the actual stock will cost in collateral, right? So if you wanted to sell a put, you can sell it, but you need to have enough money to buy 100 shares of the actual stock. And that money is going to be put in sort of like an escrow, right? Robinhood will lock it up. But you will still make money off of the direction. If you get the direction right, you're going to make the profit. If you get the direction right within this time, you make the profit, and then they release your collateral to you. So that's the main options. You buy a call or you buy a put. You sell a call if you own the stocks. You can sell the call to make residual income, side money, right? Money on your stocks. Or you can sell a put. In order to sell a put, you need to have that money available in case you need to buy the 100 shares of that stock. That's all I got. That's all I got, man. Y'all got me working, but that's my time. I got like 50 seconds left. But I hope y'all picked up some game, man. This is Block Street. This ain't Wall Street. Them other niggas will charge you crazy money for this. And I ain't even sell you nothing. I didn't even mention a Discord. I didn't even say, hey, because of blah, 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 Let me give you this. I ain't even selling nothing. This is straight up free game. Like straight up. Nothing. I ain't got nothing to sell you. You know what I mean? Facts. Facts. This is Block Street. This ain't Wall Street. This is for the people. I'm out. Peace.